The expected increase that we are likely to see in market activity this year, leading to a good run for computer share in the information technology sector. And the second best performing area has been the discretionary space, up by 9%. So the cyclicals have really been outperforming, but we could see a little bit of profit taking today. The pre-open suggesting that we could see stocks like 10, which is up by 19% in 2013 so far, coming under a little bit of pressure. So watching the Australian market, we're expecting to see a good day for the miners, and if we do manage a gain by the close today, that would be the 10th consecutive day of gains for the Aussie market.
Be clear, because the research we were reading said that we hadn't made 10 days of gains since 1992, but you're saying it would be since 2003.
I've been running the spreadsheets over the last couple of days. So we did see 11 consecutive days of gains in October 2003. But it is very unusual for the ASX 200 to see such a big run of gains without a break. And certainly in terms of 11 consecutive days or even 10 consecutive days of gains, that's the only time post 2000 that we've seen it for the ASX 200 index.
Can you weigh in as well?
I guess if we have a look at the low credit growth environment, that's one side of the equation. But the other side is that the cost of funding for the big four banks have been coming down since the global financial crisis. So that's been a positive in terms of the underlying business. In terms of the dividend, well, we know that Commonwealth Bank's the first out of the big four to pay its dividend in 2013. So that looks like it's going to help support the share price. Over the next couple of weeks, it pays its dividend, or goes ex-dividend in February. So we are expecting some good support for Commonwealth Bank there leading up to that dividend payment. But overall, if we have a look, investors have been on this search for yield, and that's been great news for this fixed interest market, as well as those high yielders. If we have a look at the bond market, though, it's pretty much mathematically impossible to replicate the returns once again that we've seen over the last few years. And really, we're starting to see a run into equities because we have seen some of that risk aversion that dominated the start of 2012 die down. If we compare 2012 and the beginning of it to 2013, I mean, we were facing a Greek bailout, possible problems in terms of France as well as in Spain, and then we were looking at a possibility of a hard landing in China as well as subdued growth in the US.
Wesfamers, we've seen a rise in sales in the first half. Coles, with total sales of over 18 billion, it was a 4.7% rise on the previous quarter. What did you make of the numbers? I mean, it's such a diversified group, so let's just mention the supermarkets to start with, but of course we can broaden it out.
A really strong result coming through from Wesfamers. We were expecting to see a very strong quarter of growth, and the expectation was for about 4% growth in that food and liquor division. It's actually come in at 5% and at 3.8% on a comparable basis. For the half year, we saw growth across every single division in Wesfamers. And for the quarter, we saw some strong numbers coming through from home improvement. We saw an increase of 6.8% there, 4.2% on a comparable basis. So it's quite easy to see why its competitor Woolworths wants to roll out those master stores in that home improvement space. We did see Kmart also doing well. In fact, the 12th quarter of growth that we've seen, the growth of 3.8% or 3.7% on a comparable basis, and Target managing growth of 0.6%, although that was a negative 0.2% on a comparable basis. And we know that Target has problems. It's been struggling in that electrical as well as the entertainment area. Food deflation was one thing that we were watching, and we've now seen 13 out of the last 14 quarters are seeing food deflation for the supermarkets. But we did see food deflation really easing. I mean, the previous quarter it was at 3.2%. We're now seeing it at 0.9%. So we are seeing an easing of those conditions. But all up, we are expecting to see Wesfamers continue to outpace Woolworths. Part of that has to do with the Victorian gaming and the changes there and the Masters rollout as well. But in the last 52 weeks, we have seen Wesfamers and Woolworths have quite a similar performance, and that's something that we haven't come to expect. Usually what we see is Wesfamers' share price beating Woolworths by a substantial amount, but both stocks are up around about 30% over the last 52 weeks.